You just checked the news and saw that the Federal Reserve did something. Maybe you read the headline twice. Maybe you scrolled past it. Maybe you heard someone at work say something about interest rates and inflation and a guy named Kevin Warsh, and you nodded like you understood exactly what they meant. But here is the real question. What does any of this actually mean for you? Not for the economy in the abstract. Not for some graph on a financial news channel. For your wallet. Your rent. Your mortgage. Your credit card. Your savings account. The stuff that actually touches your life every single day. And here is what almost nobody explains. The Federal Reserve operates exactly like the game master of the world's most complicated role-playing game. It holds a set of controls that affect every single player on the map. And the move it just made is one of the most consequential gear shifts in recent memory. A new chairman just took the helm. His name is Kevin Warsh. And in his very first meeting, he sent a signal to every investor, every homebuyer, every borrower in the country. The era of cheap money is probably over. And a rate hike might be coming. To understand why that matters, you need to understand what the Federal Reserve actually is and what it actually does. Think of it as the dungeon master of the American economy. It does not make things. It does not hire people. It does not build roads or sell groceries. What it does is control the cost of money itself. And the lever it pulls to do that is called the federal funds rate. The federal funds rate is the interest rate at which banks lend money to each other overnight. That might sound abstract and irrelevant to your life. It is not. Because when that rate goes up, the cost of borrowing money ripples outward through the entire economy like a shockwave. Mortgage rates go up. Car loan rates go up. Credit card rates go up. Business loans get more expensive. Suddenly, spending money you do not have costs more. And gradually, the economy cools down. Think of it in game terms. The federal funds rate is the game's difficulty slider. When the Fed turns it down, the game is easier. Money is cheap. Credit is easy. People buy houses. Companies hire. The economy expands. When the Fed turns it up, the game gets harder. Borrowing becomes expensive. People spend less. Companies slow down. Inflation, the thing that makes your groceries cost more every year, starts to come back under control. This is the core mechanic of monetary policy. And for the last several years, you have been playing on a version of this game where the difficulty kept shifting. First, the game was turned all the way down to easy mode during the pandemic. Rates hit near zero, and money flooded into the economy like coins raining from a broken vending machine. Then inflation surged to 40-year highs, and the Fed slammed the difficulty slider all the way up, raising rates at the fastest pace in decades. Then, at the end of 2025, they started cutting again, bringing rates down 3 times from a peak of over 5% to the current range of 3.5% to 3.75%. And now Kevin Warsh has taken over as chairman of the Federal Reserve, and everything just changed again. Here is what happened at the June 2026 meeting, and why it matters more than the headline number suggests. The Fed voted unanimously to hold rates steady. No cut. No hike. The rate stays where it is. That sounds neutral. It is not. Because what the Fed communicated alongside that decision was far more important than the decision itself. 9 of the 18 members of the rate-setting committee, nearly half of the entire body, signaled in their forecasts that they believe interest rates will need to go higher before the end of 2026. Not lower. Higher. In game terms, the dungeon master just told you the boss fight is coming. Even if nothing happened in this room today, the warning has been issued. The reason for this shift is a familiar villain with a new power-up. Inflation. The Consumer Price Index for May 2026 came in at 4.2% annually. That is a 3-year high. The Fed has been trying to get inflation back to 2% for 5 years now. 5 years of missing its target. The reason it surged again this time is partly a war. The Iran conflict that began in late February caused energy prices to spike, and energy prices bleed into everything from gas to groceries to shipping. This is what economists call a supply shock, and it is one of the hardest things for a central bank to respond to. Here is why. If inflation is rising because people are spending too much, what economists call demand pull inflation, the Fed's tool works perfectly. Raise rates, make borrowing expensive, cool spending, prices come down. But supply shock inflation is different. It happens not because people are spending too much but because the supply of something critical, in this case, energy, suddenly became scarce. Raising rates does not make oil wells produce more. It does not stop a war. It just makes everyone's life more expensive in a different way. This is the trap the Fed now finds itself in. And Kevin Warsh, inheriting this situation on his very first day as chairman, chose to be clear about it rather than reassuring. His policy statement was shorter than any in recent memory. He dropped what is called forward guidance, the usual language about where rates are headed, and replaced it with a message that amounted to, "We will fight inflation." Full stop. No hints about cuts. No plot forecast from Warsh himself. Just a clear signal that price stability is the mission, and the committee is prepared to raise rates if necessary. To understand why this matters, you need to understand something that economist Milton Friedman described decades ago. He called monetary policy a blunt instrument with long and variable lags. What he meant was that when the Fed raises rates, the effects do not show up immediately in the economy. They show up 6 months later. A year later. Sometimes 2 years later. The economy is not a video game where you press a button and see instant results. It is more like planting seeds. You make a move today and then you wait and watch for the consequences to grow. That lag is exactly what makes the Fed's current position so difficult. The rate cuts of late 2025 have not fully worked their way through the economy yet. And now new inflationary pressures are arriving from the Iran war at the same time. The Fed is essentially steering a ship while looking at a map that is 6 months out of date, in weather that changed yesterday. What does this mean for you? If you own a home already, the short-term effect is limited but real. Mortgage rates are influenced by, though not directly tied to, the federal funds rate. They also respond to something called the 10-year Treasury yield, which spiked sharply after Warsh's press conference. When Treasury yields go up, mortgage rates tend to follow. That means refinancing just got more expensive, and if you have a variable rate product of any kind, you need to pay attention. If you are trying to buy a home, this is the worst level of the game right now. Rates were already high enough to make affordability a crisis in most major markets. The possibility of another rate hike on the horizon keeps those rates elevated and removes the urgency for sellers to drop prices. You are essentially being told by the game master that the dungeon gets harder before it gets easier. If you carry credit card debt, this is a direct hit to your character stats. Credit card interest rates are closely tied to the federal funds rate. They moved up almost immediately when the Fed raised rates in 2022 and 2023 and have stayed elevated. They are not going to come down until the Fed signals that cuts are coming again. And right now, that signal is going the other direction. If you have money in a savings account or a money market fund, this is actually a buff for you. Higher rates mean higher yields on cash. If you are not currently keeping your cash somewhere that pays you a competitive rate, you are leaving real money on the table. And if you invest in stocks, the math just got more complicated. When rates are expected to stay high or go higher, the future earnings of companies get discounted more heavily, which tends to push valuations down. The stock market fell after Warsh's press conference, and that is exactly the mechanism at work. Higher rates make future profits worth less in today's dollars. Here is what the research tells us about how to navigate this kind of environment. John Bogle, the founder of Vanguard and one of the most studied voices in index investing, spent decades arguing that the correct response to any interest rate environment is not to time the market but to stay invested in a diversified portfolio and let time work in your favor. His research, and the research of dozens of economists who followed him, consistently shows that retail investors who react to Fed decisions by moving in and out of the market consistently underperform those who do nothing. Gary Shilling, the economist who has studied interest rate cycles for over 50 years, makes a different point that is equally important. He argues that the most dangerous thing an investor can do in a rate cycle is assume the current trajectory will continue indefinitely. Rate hikes end. Rate cuts end. The game always changes. And the investors who win over the long run are the ones who position themselves for the next phase before the crowd noticed it was coming. What you are watching right now is a transition. The Warsh era at the Federal Reserve is beginning. The language is tighter. The forward guidance is gone. The possibility of hikes is back on the table. And an economy already navigating tariff pressures, a wartime energy shock, and 5 years of above-target inflation is about to find out whether the new dungeon master plays it hard or finds a way through. The Federal Reserve just sent you a message. The difficulty slider is not coming down anytime soon. The question is whether your financial character is built to handle what comes next. And now you understand what actually happened when you saw that headline. The Fed held rates steady. But the game just got harder.